In the previous lecture, we talked about different types of derivatives. We said we have options and forward. In this lecture, we're going to dive into different types of options. We have call and put options. Also, in each contract, there are two sides, which makes sense. We're going to talk about these different sides, what names they have. Holder and writer are the names that these different sides have. Well, we're going to learn lots of terms in this lecture, and this is one of the most important lectures related to derivatives. Let's get to it. Option positions. Generally speaking, every option contract has two sides. The person who is holder and holds the option with the right to decide, and the person who writes the option. The party that is taking on the obligation. So, in simple terms, holder decides. Remember with the first word of each one, HD, holder decides, and writer is obligated, WO, okay? Writer is obligated. So, remember, holder has the upper hand and decides whether to execute that contract or not. The writer is obligated, okay? The writer is the one who receives the premium. In the option, we talked about it in the first lecture of this chapter, that in the option, just one party is obligated to do something and the other party have full right to do or not to do execute the contract. Okay. Now, there are two types of options, call and put. Please don't be confused. Each contract has two sides, as we've said. We said there are holder who decide and writer who is obligated, okay? Now, we are saying there are two types of options, call and put. A call option gives you the right, okay, but not the obligation, the right to buy something like a stock, oil, gold, exchange rate, anything at a specific price called the strike price. That specific price, his name is strike price before a certain date. Okay. Why it is called call option? It is called a call because the buyer of a call option has the right to call or demand the stock from the seller at the agreed price. Essentially, you're calling the stock to yourself by buying it. Okay? So we now understand the call option. Call option gives you the right to buy something. Okay? So CB, call option, give you the right to buy something. Put option, on the other hand, gives you the right to sell something. So put sells. To sell something at a specific price before a certain date. Why it is called put? Why the name put? It is called put because the buyer of a put option has the right to put the stock to the seller at the agreed upon price, which we said that it's strike price. Essentially, you're putting the stock onto the someone else by selling it. Don't feel overwhelmed, don't feel confused. We will elaborate with an example, so just relax, okay? We're going to have lots of examples for put and the call options in this lecture and in the future lectures. So just understand this, that we have two parties, two sides for each option contract, which was holder who decides and writer who is obligated. And we had two option types, which is put option, which gives you the right to sell something, and call option, which gives you the right to buy something. Now, let's say two parties want to sign a call option contract. Okay. So we know the type of option here is call. And we already knew that there are two sides to each contract, holder and writer. Okay. No matter what option type is, we always have two sides to a contract. In this call option contract, the two sides are called call option holder and call option writer. What's the difference? Let's elaborate. Call holder or call option holder means you're buying a call option. Okay. You're paying for the right to buy a stock, oil, gold, anything at a set price before a specific date. Okay. And call writer means you're selling a call. Okay. You're agreeing to sell someone a stock at a set price. You're obligated to do this because you're a writer. Okay. You're obligated to sell a stock at a set price if the call holder decide to buy it from you. Now, let's elaborate with an example. Okay. Just relax and listen to this example. Let's say XYZ stock is trading at $50. You think it'll rise to $60 in 3 months. Okay. On the other hand, Jack, who's your friend, thinks it'll go down to $40. So you and Jack have different perspective to that stock price. Okay. So you guys are agreed to sign a contract here, derivative contract. Okay. In the contract, you mentioned that you will buy 100 XYZ December 55 calls with $1 premium. What does this mean? It means you are in a call buyer position, okay? And Jack is in call seller or writer position. Call buyer means call holder. You are the decision maker, and Jack is a call writer or call seller. Jack is obligated to do if you want to execute the transaction. So you give $100 as a premium to Jack to have the right to buy the XYZ stock from Jack at strike price of, let's say, $55 by December. Did you see that contract line? 100 XYZ December $55 calls with $1 premium. It means 100 units of XYZ stock. Okay. The maturity date, the date that contract expires is December. $55 is the strike price, the price that you will buy the stock from Jack. Okay, $55. Calls means the type of contract, type of option contract is calls. And $1 premium means to have this right, you are paying $1 premium to obligate the Jack to sell you the stock at $55. Now, as always, two scenarios might happen. If XYZ stock goes up, okay, it's in favor of you. As you expected and as you planned, it is going up. So you execute the contract. Okay. Let's say it goes to $60. You execute the contract and you buy 100 stocks from Jack at $55. So, and you can sell it right away in the market at $60. So your profit is $5 here. But remember, you paid $1 per stock premium to Jack. So we need to deduct that cost you have incurred. So $5 minus 1 equals to $4 is your real profit, an actual profit from this call option contract. Now, let's get to put option. Let's say two parties want to sign a put option contract. Okay. So we know that type of option here is put. And we already knew, again, there are two sides to each contract, holder and writer. Okay. Holder, HD, decides. Writer is obligated, WO. Okay. In this put option contract, the two sides are called put option holder, who decides, and put option writer, who's obligated. Okay. Put holder or put option holder here is paying a premium for the right to sell a stock at a set price before a specific date. Okay. Put writer, on the other hand, is agreeing or obligated to buy the stock from the put holder at a set price. Okay, let's break it down with an example so you will totally understand, I'm sure about it. Let's say XYZ stock is trading at $50, again, just like the call option. This time you're thinking that this stock price will drop to $40. Okay, in the call option, remember, you were thinking it'll go up to 60. In put option, you're thinking that it'll drop to $40 in 3 months. On the other side, Jack, your friend, thinks it'll go up to $60. So you and Jack have different perspectives. You guys sign a contract, sign a put option contract, okay? You buy 100 XYZ December $45 puts with $1 premium. What does this mean? Let's go one by one. 100 means 100 number of units, okay? 100 stocks. XYZ means the name of the stock. December means the time that put option contract expires or matures. The holder needs to decide by December, okay? $45 is the strike price, is the price that you and Jack agreed that you, as a holder of put option, can sell the stock to Jack at $45, not buy. Here it's put option, okay? Don't confuse with call option. Here, you are the holder of the put option. So you guys agreed that you can sell the stock to Jack at $45 per share with $1 premium. To make Jack to buy it from you and to make him obligated, you're paying $1 in premium. Okay, so you're in total for 100 units of stock, you're paying $100 to Jack. Again, two scenarios might happen. If XYZ stock goes down as you planned and expected, it's in favor of you. So you execute the contract. And what happens? You will profit. Why? Because out there in the market, the price of a stock is $40. Okay. But you signed the option contract, you signed the put option contract with Jack, and you said in that contract that, hey, Jack, you have to buy the stock at $45 from me. Although the price of a stock out there is $40, I don't care. You have to buy it from me at $45 because we signed the contract. Okay. So your profit here is $5. Out there in the market, it's 40. So you buy it exactly in the market and then you sell it at $45 to Jack. So Jack's loss is $5, your profit is $5. But remember, To obligate Jack, you paid $1 in premium. So you need to deduct that $1 from your profit. So your real profit here would be $4 per stock. Your contract was 100 units of stock. So 100 multiplied by 4 equals to $400 is your actual profit from this put option contract. Now, if the price goes up, okay, let's say the XYZ stock price goes to $55 or whatever, okay, goes up, not as you planned. You won't obviously execute the option contract, the put option contract, because it's not in your favor. The only loss you are incurring here is your premium. The Jack, who is the writer of that put option, writer is obligated. Okay, the Jack keeps the premium you paid, and you, as a holder, you decide not to execute it, and your loss would be that premium you paid to the Jack. Awesome! What a lecture! And I think you grasp the concept here, but if you didn't, don't worry at all. We're going to elaborate on this put option and call option with an example in coming lectures. So stay tuned, please. Thanks for watching. Keep it up, and I'll see you in seconds.